Welcome to the Established Podcast, conversations with founders, investors, and changemakers shaping the future. Each episode uncovers the stories and lessons driving today's innovation economy. Powered by Established, we spark innovation and build connections that matter through strategy, storytelling, events, community building, investment programs, and more. Now, let's dive in.
Hello and welcome to the Established Podcast. I'm Frank Gruber, your host, co-CEO of Established, as well as managing partner over at Established Ventures. Today, I'm super excited by having our guest, Charlie O'Donnell, here. He's the founder and general partner over at Brooklyn Bridge Ventures, which invests in early stage startups in NYC. And he's also formerly of Union Square Ventures. He's got 20 plus years of startup and investor experience. And he just wrote a book published by Wiley called Founder Unfriendly, What Investors Won't Tell You About Getting Funded. Welcome, Charlie. Thanks for being here. Been a while.
Thanks for having me. I really appreciate you and really appreciated what you guys have done for a long time. You've been community first and whatever you are doing professionally second. And I just appreciate the non-transactional nature of you just getting out there and connecting to people.
Well, thank you. I appreciate that. And we've always tried to do that. So that means a lot. All right, let's jump in for folks that don't know what you've been up to. Let's give them the quick version. I'd say Cliff Notes, so that'll date us. I don't think that even exists. Does that even exist anymore? I don't even know. But
No,
let's
it's the Claude summary. I think
Claude
now.
Summary of what
Yeah.
you've been up to and how you got to this position to want to write this book.
So I've been in VC basically my entire professional life. I actually started off on the institutional limited partner side. So when you're pitching a VC, you don't often think of where their money came from, but they had to pitch for it. So if you're going through the monotony of fundraising and pitching and pitch decks, at least you know the person across the table had to do the same thing. Granted, not as often as you did, but so I was at the General Motors Pension Fund taking pitches from, you name the brand name VC firm. We were invested in them since well before my time. Actually, the guys from Union Square Ventures, Ed Wilson and Brad Burnham, came to pitch me in 2004 when they were raising their first fund. They didn't get money, but they got me. I'm not sure they'd take that trade-off again, but spent a couple of years there, helped First Round Capital open up its New York office. And then after first round, broke out on my own to start Brooklyn Bridge Ventures, where I raised 3 funds, did about 105 investments. And in general, how that led to the book is that most people you have to say no to. And for most people, this fundraising process is a struggle. And I'm someone who always tried to get out there and help more people rather than less. And venture is kind of about helping less people, right? It's in every room full of 100 people. It's finding the 1 or 2 people who have that IPO level potential. And the book is my way of getting out to the 98 or 99 and saying, yeah, this is really hard, but let me sort of demystify some of it for you.
That's great, because I feel like because of the way things have gone so mainstream with investing, especially in just startups, right? Like there's TV shows about it that didn't exist 20-something years ago. It's become really glorified to the point where it looks like, everyone's going to raise their funding and it's a big deal. And then, that's not always the case. Not every company is investable in the way that you're looking at it. And there's different investors for every type of company, really. So I think it's really helpful. It'll be helpful for founders to understand this. So let's, why though the provocative title Founder Unfriendly? Like what was it? How did that surface?
So it's getting a lot of buzz and
Airplane.
Yeah, it's funny. When I first started my fund, it was the first venture fund to open up in Brooklyn. I got a little CNBC segment. And I live in this where I have never had a non-New York City address. So New York noises just blend into the background for me. I don't even notice them. But then when I'm on camera or whatever, I did an interview by the Manhattan Bridge where a subway train goes back and forth. I know it's this would be a great spot. Every 2 minutes, train rumbling back and forth over the bridge.
Mm-hmm.
It did keep my answers very concise though, because I had to fit them in between train runnings. So the title actually comes from the fact that if I've ever been on a panel or a pitch competition, multiple times I've been called Simon on that panel because Simon Cowell, the sort of, I'm very direct, right? And what I think happens too often is founders get feedback that is either that's interesting or some level of brush off that enables the investor to say, well, we didn't quite pass on you, but we don't really want to write you a check now. none of that is helpful, actually. So I think the most founder friendly you can be, sometimes saying something that's hard to hear, right? And
Mhm.
sometimes saying, I don't think this is the thing. I don't think this is the thing that you should be working on. And, when you quit your job or you raise friends and family money, or you go all in on social capital and tell everyone you're working on something, that feels very unfriendly. That can feel mean. And it's not to say that anybody's sort of not thick-skinned enough for this. When you're all in, getting pushback on something is tough to take. But I feel like the most help that I can provide is giving that very tough to swallow feedback for people. And so that's why I'm not trying to be your friend. I'm trying to be honest with you.
No, I think that's really great. And I think in this world, I don't know if everyone can handle direct. I don't know. They have a hard time with direct, and it sometimes comes off as being like maybe that's not a nice person. That's not. You're actually being super nice, like
Trying
by
to.
being direct. You're saving them time. And I think it also goes on the other side too. Like if you're an investor, I guess if investors are listening to this, what's a better way to say maybe later because you're not ready yet? Like what's the best way to say that? And not because I think that's why some investors keep it kind of lukewarm because they're hoping maybe they'll come back later when they're more ready or something like that, but they don't want to burn that bridge. And I think they're trying to be nice.
Well, I think you have to be careful with not ready
Yeah.
versus this is not a good idea, but you're a smart person and there's a chance you might pivot into something else later.
Right. Right.
Those are two different things. And I think people should be honest about that, right? So
Mm-hmm.
I recently was helping a founder with some feedback. And like there were things that he didn't know yet about e-commerce go to market or product development that are just like answers that she was going to have to defend a pitch, right?
Mm-hmm.
Shouldn't fully walk through the financials of what she would do at certain size rounds and a bunch of low hanging fruit that to me was like you're not ready yet. Like there's a whole bunch of work you need to do to establish that like this plan is sound, to create a compelling deck. Like I think you've got like 6 more months of work on this, but the product was compelling enough at a first glance, right?
Mm-hmm.
That's very different than saying I'm a pass, but should you pivot into something, right? Like I took one of the earliest pitches of classitivity. Classitivity was like, what is that? Well, before it pivoted into the class pass, it was
Mm-hmm.
something else entirely, right? And so that was, sat down with Payal and was very impressed, but it was like a class search. There was no offering you could buy. I didn't know what classes were available. I didn't know what to search, and it was kind of a fail on delivery. And so she never came back to me to pitch the pivot into ClassPass, right? So maybe I should have like hung around the rim, but I was just a flat no. And I
Mm-hmm.
was very specific about why it was a no. Now, for investors, a lot of times founders appreciate that, especially I find when you don't even take the meeting, when you basically tell people like, hey, this doesn't even meet my bar for taking the meeting, and here's why, so I'm not going to waste your time. And I think founders appreciate that.
Yeah,
Their
I
time is
would.
valuable too, right?
Yeah, no, 100%. I think why waste it on both ends, right? Why? And I think that's interesting about that company that and they probably didn't come back because they thought, oh, he's a no anyway. But
Right.
they could have been a yes. So I think that's the interesting thing and why some people they're trying to figure out what's the right language to use. But if they were just honest to begin with, like, hey, not right now, maybe later, maybe that'd be a way to do it. All
And I
right,
think
let's
the
move
more
along here.
specific you are, the better.
Yeah,
Like,
absolutely. Yeah.
here's the reason why. Oh, okay. Do I want to push back on that? Or, oh, that's helpful feedback. I disagree
Mm.
with you, but here's what I can fix.
Yep. What do you think is, from a founder perspective, is most misunderstood about venture capital decision making?
I think it's the idea that this is a judgment of like good company versus bad company versus the idea that this is a financial product. And I'm trying to figure out if this financial product is a fit for what you're offering me, right?
Hmm.
There are some good companies that, you could scale this thing, maybe raise a little bit of capital and sell this for like 30 to $50 million. And as
Hmm.
80% owner of the company would be a great outcome for you, like a generational wealth building outcome. It's just not a fit for a $200 million venture fund.
Yeah.
Right. And that right there, so many times when we hear no, we think that somebody says this is a bad business. When in reality, like it could be a very good business, like a 7 out of 10. or just a business that the type of capital I'm offering does not fit with like what the natural path of this thing in the future is.
I think that's the biggest issue with the glamorization of fundraising in general with startup land is that the no isn't because of what you just said. It's sometimes it just doesn't fit their model. Like it's just the
Right.
wrong. And I think that's
Right.
the hard
NEA is looking for
out.
decacorns. They have a $3 billion fund to put to work, right?
Right. Yep.
You could be on a path to sell for 150. You're going to be a pass from NEA.
Yeah. 100%. And I think that's the interesting, needle in a haystack problem that founders face, right? Trying to figure that out. And so, from your perspective, what are some of the things that when you've seen companies you've shared maybe that might help them better prepare for that, or even find the right needle in that haystack?
Well, I think the first thing is founders need to be honest about like, what is the plan here? Like, is your plan to take it to $500 million in revenues? Do you want to do that and push it well beyond 50 or 100? The risk that it's a zero, right? I gave a talk a couple of weeks ago in front of a group of about 60 or 70 entrepreneurs, and I said, "Who here is okay with this company going to zero?" I'm like, only two people raised their hand, and I was like, those two people, they're the only ones who should raise venture
Mhm.
because that's literally what venture does. Was that I come along, I write a check, I ramp up the potential of this because now you've got gas on the fire, but you also have a fire, right? And you increase the chance that this could be a zero. You make decisions where you're swinging for the fences. It increases your chance of striking out, right? And if you were in a financial position, for example, where you cannot risk 5 to 10 of your prime earning years on something whose equity value results in a zero, then like this isn't right for you. This isn't a
Mhm.
good fit, right? And let's be honest about where you're taking it. And I think signaling is also really important too. Too often people come in and pitch. They don't put the hockey stick chart in the deck. You might say that's BS, but am I to assume you are driving this to $200 million in revenue and that's your plan? Why would I assume that? Why wouldn't I assume, like every other economically rational person, that you hit $5 million and break even, and you're like, this is cool, just going to grow steady from here, which is like a rational business person would do if they didn't know that you had growth capital on your cap table that needed it to be a decacorn, right?
Right. Yeah. That's great. Yeah, that's really interesting. I mean, I guess for those that are, not everyone's fit for raising that kind of money, right? And raising and putting that pressure on yourself. So I guess for those founders, I'm sure you've met a lot of them. What advice would you give them? Like if they're not, because I think what's happened is everyone's gotten so tied into, well, I've got to go become a unicorn, right? And I've got to raise the money, but maybe their model doesn't fit that, or maybe their psychology just behind the scenes doesn't fit that what they're trying to do, and they don't put their hockey stick in the deck because of that. So what are those other options for them?
Well, I think there are a couple of things. First of all, I think AI is going to be a really interesting shift. I think the fact that less capital is needed to get to a interesting size for entrepreneurs is going to have to force the hand of the VCs. I think you're probably going to see a fracturing of the market where, you go and pitch a VC and they are more than happy to fund you with small amounts of money to get you up to, I don't know, $100 million valuation
Hmm.
and a potential exit. And then maybe you take some money off the table at that point. Maybe you hand it off to a CEO who wants to take it from 100 to a unicorn, and you've done very well for yourself. You walked out with 20 or 30 million bucks and you're off to go start the next thing, and somebody else can hand it off from there and they can take a different level of risk. I mean, there's all sorts of ways that you can structure transactions when you're in the driver's seat of like generating cash flow and all of that. I just think it's really key to spell out your intentions, make it clear and transparent, like where you're taking this, what you think the potential is. And that's when you can also get into angel capital and people for whom 4 or 5x and something interesting in their space and strategic and something that they can learn by participating in or feel good about. That's where those people are good fits, right? Especially customers, people for whom they want to see this company exist. It's strategically important for them. And, whether or not you're a unicorn is sort of secondary.
Yeah, that's really interesting. Makes me, yeah. So I think from my perspective, I'm just thinking about like from a fund perspective too. Are there going to be smaller funds? Like, are they going to just be more smaller funds looking for those. I mean, we're almost turn the clock back 20 years to like when there were smaller funds and $100 million,
The super angels and
right, $150 million exit was a win, right? And now
uh-huh.
it's like that's not necessarily the case with some of these larger scale funds. So it's
I had a
interesting.
portfolio company that raised a pre-seed, a seed. Now this is going back a couple of years ago. The seed was, I think, at a post of 16,
Mhm.
but combined between the pre-seed and the seed, private equity firm came and bought 90% of the preferred off the cap table at a price of, I think it was like 160 or something like that, which is like not a huge outcome. I basically got like 15x on it and returned like almost half my fund because I have a relatively small fund.
Yep.
There was no
Yep.
fundraising in between the seed and the other round. Like
Right. Yep.
that's an awesome outcome. And there are smaller funds, right? Everyone you know is a scout, has a little side pocket fund, is doing some kind of SPV or
Right.
whatever. And those folks understand their own economics, right? Like those near term wins, why sign up for 12 years in an IPO when you can sign up for 3 or 4 years and a 50 to $100 million exit? And
Right.
you're actually probably a lot more aligned with the founder at that point.
Right. Yep. You're not losing total control of that. That's interesting. Okay. What are some things that maybe investors are not telling founders about how the actual fundraising process works? What are some things that
I
come to
mean,
mind?
do they tell founders anything? Anything useful?
Hmm.
Um, Did a really good post. I should go look up to see who wrote this. A founder turned junior venture capitalist who swore he was going to tell the truth to founders because he felt like he never got good feedback. And he's in his firm, and so much of the discussion about the company was about the team. And so he's like, "Oh, team is the reason why, we're turning some of these things down." And so I'm just going to be honest that when it's the team, I'm going to tell them. And like, you can imagine how well that went over. That didn't go over well at all.
Not if
Um,
they're hearing what they want to hear.
no, no. And so, I think the thing is that a lot of feedback isn't really prescriptive, right? So people say team is important, but yet there are lots of teams that look like every other team to just happen to catch the car, right? They get some traction on something and you might be more qualified than them to do that, but they just nailed the user experience or whatever luck they ran into, right? Team, however, is a reason why things are often turned down, where just somebody looks and says, I don't think your skill set matches the challenge of what's going on here, right? You're just two former hedge funders who, have some toddlers and think, the games for our kids out there are kind of lame. Like, we're going to go build something, right? Are you a game designer? Like, are you a child education expert? Like, you're just not really equipped to be, the next whatever the, kids are watching now and all of that. So, I think it's hard because startups aren't often comparable. That's one of the things I wrote recently. I wrote this post that venture capital has a starting line problem. And I think too often we get caught up in like what are comparable companies. And I've backed a fairly diverse set of founders. And the reality is every one of my founders that has had 5 venture-backed friends is at a huge advantage. Not because their insider network is making special intros to them. It's like you have somebody you can flip a deck over to and just say, hey, what do you think? Or who should I ask about this? Forget about the intro, just like who's out in market. How could I not screw up on this VP of sales hire? Like all of those things are such a huge advantage. Like those networks are not evenly distributed. You could have the same idea as somebody else, but if that somebody else is Mark Laurie, Mark knows the first 50 people he's going to hire at his next huge e-commerce business because they're all former Jet, former Wonder, former Quidsy folks, and he's not going to make any first-timer mistakes anymore, right? So there's no way he's not like a definitively better bet out of the gate, even if your idea is slightly better.
That's really interesting about team. I think there's a lot of assumptions that go into team. So you always remember that deck slide that's got the team and the logos of where they worked and all the things they've done. And there are a lot of assumptions that go into that, right? And I think what you're saying is dig into the network, like dig into their network to see if that's real, and that could be really more powerful than some of the logos they put up or whatever. And then the other thing that maybe you made me think of was, you know, sometimes you kind of want to, like you mentioned, the 2 hedge fund guys that maybe will have this idea. I'm thinking about some of those, you kind of need to figure out a test to like almost like test them on like, are they going to not give up Like, are they not going to stop until this is successful? I think that's a big one with team members as well. Is like sometimes people may be a little too comfortable and maybe not give it an all because of that. They're used to something else.
Well, and actually, I'll even push back on the give up thing. I want people as an investor to give up on bad ideas, right? I want to invest in the Odeo to Twitter pivot, or I
No, true. Yeah.
especially in an age of AI where you could like vibe code a whole new product over a
Right.
weekend. And I would love it if a founder came in and said, I just, you know, I just don't think this product has legs. And I think there's something we learned about it. And I've been talking to customers and like, let me show you a new thing.
Yeah.
And
I guess when I
that's
say
fine
give up,
too.
don't give up until they figure it out.
Right,
So I guess the
right,
point
right.
is like, yeah, that's right, 100%. Like they're gonna figure out what that thing is and not like, call it quits or whatever it is.
And I think this
Uh,
goes back to like, we're so focused on the product. I was actually talking to somebody about this the other day who was outside the venture ecosystem, and they
mhm,
they were talking about Shark Tank. And Shark
mm,
Tank is like, let me show you my product. Isn't it awesome?
mhm,
And I think we need to be much more problem focused,
mhm,
right? Like, I have gotten to know this particular customer. Here's the pain of their job. I don't totally know what product will solve that pain, but I'm very well versed in that pain. If you are very well versed in that pain, you will probably figure it out on the product side, even if you don't do it day one.
yeah. Yeah, I agree with that. And I'm not always been a huge fan of their model in general. So I think, yeah, it's put a lot more pressure on just the product versus the problem. And even those deals are not great. And so which makes it hard for them to make that into, something that could pivot to make a problem solved, right? Or whatever. So, all right. So okay? So we've been kind of gone off on a tangent there, but let's dive back in a little bit more on the psychology of and maybe some of the power dynamics of from an investor perspective. So what are founders missing when it comes to understanding the investor kind of incentives? I guess you could say, and we've talked a little bit about it and fund size, maybe not matching up, and maybe not the right company at the right time, or maybe they don't even have any capital left, or whatever. There's a lot of them,
Right.
but I want.
And there's a lot of team dynamics there too. You're pitching oftentimes just the person on the front lines, right? Might
Mhm,
be a little junior, probably unless you're like already connected. Um, you're not talking to the person who has the most juice within the firm on the first day. And so what you're really trying to do is like perform inception, right? You're trying to drop an idea
mhm,
into this person's head that is going to spread and grow, right? Because the Monday morning partner meeting is the dynamic that no one thinks of. It's probably the most important and critical moment in your interaction with this VC fund, and you're not even there, right? Because if you have an overly complex pitch that someone who heard about it for the first time this week can't repeat on Monday, they're never going to lasso up the resources to get this firm and the team interested in spending more time with you. And that's something that I think founders spend too much time trying to differentiate, right? Trying to say, no, no, no. We're way different than we're so much more complex. We're so much more interesting than, what somebody else is doing. Let me tell you all the ways we're special. And they forget to figure out the simple version of what they're doing. To just buy more resources at the firm. Hey, we figured this out and here's our quick insight. Cool. Somebody can repeat that on Monday morning and go, that's kind of interesting. I'd love to talk to that team more. And then you can really get into it.
That's such an insightful piece of knowledge you just shared. I don't know if founders are thinking about it, what you just shared about the Monday morning partner meeting. I mean, I think, and being able to tell their story to those folks, which basically makes your story the most important thing you can do, is like making sure your story is clear and understandable and repeatable.
Right, right, exactly. Because it's got to withstand the wasn't it like those guys or those like I went into the when Nick Bilton wrote the Twitter book. There's a little blurb in it from that South by Southwest in 2007, which probably you were at.
Yep.
We're all watching Twitter blow up, and there's an
Hmm.
exchange where I wasn't at Union Square Ventures anymore, but I emailed Fred Wilson and I was like, "Oh, dude, I totally get Twitter now. Everyone down at the conference is down here." However, I described it to him didn't initially land, because his
Mm,
first response was like, "Oh, Gordon Gould did this with UPOC, group text messaging back in." It was like, that's not totally what it's like, right? Like I hadn't perfected my pitch to him
right.
enough, and I nudged very persistently, and he joined Twitter 2 days later. And then sort of the rest is history, right? But
Yeah.
like, you get a one-liner basically, and the one-liner can't be flowery language. It can't be AI generated. It just needs to stick.
It's a really fun story about Twitter. And I mean, just thinking about it in retrospect, I mean, the mobile phone, right, was such a big part of that, right? We didn't have that with the other group message. I mean, AIM was Twitter, but that
Right.
didn't work the same way. It's very, very similar.
Aim away messages.
Right, exactly. Let's see. Let's talk about AI. You mentioned it, and you definitely we're in a tsunami right now. I feel like every week's like a year or something in AI land. How do you see that? How are founders going to navigate that? What you mentioned, like making it easier. Like, what else do you think about when you think about AI and the way things are kind of moving at the speed they're moving at?
So first of all, I wrote the book from February until August of last year, and like, what an incredibly different world we live in.
Yes.
I mean, I look back in hindsight, I'm almost a little bit self-conscious of the fact that there isn't enough like AI playbook, not like how to build an AI company, but just like using AI in your founder workflow,
Hmm.
right? Like you have your list of 100 VCs you're going to go pitch to, but you can use AI to like go grab all the podcasts they're in, figure out like compare your deck to the thing that that founder just said on the last 5 podcasts that they were on, that VC said on the last 5 podcasts they were on, craft a unique message, like all of this sort of stuff. Or, for example, using Granola or whatever your recorder of choice is to transcribe your meetings, to go run it through Claude and say,
Hmm.
did my pitch land? You're a founder, right? You're drinking the Kool-Aid. You come out of every meeting thinking, oh, those guys loved it, right? Did they? Like your job was to prove this was a big market. Did they actually, can AI scan the transcript and indicate that somebody from that team actually said, I agree with you, this is a big market? Like that's a
Or are you just hearing it in your head?
you're just hearing in your head, right? Exactly, right? So there's so many tools to be able to do that. So one of
Yeah.
the things I actually did with the book is I created a sort of microsite at thanks to AI dot
Hmm.
this is going to be big.com, and there's a whole section of a bunch of Claude prompts that founders can use to sort of judge, is this really venture backable, or what's my mindset going into this, and all of this sort of stuff. But a purchase actually unlocks an AI fundraising coach. So I uploaded all of the frameworks and everything from the book, in addition to dozens of real meetings that I have had with founders, where I trained the AI to disturbingly sound like me and interact with founders like me, so that you can go upload your deck and have a whole conversation with a bot that is built off of everything that's in the book and a whole bunch of real meetings. And I've now put about 50 decks through it and sort of run these like founder role playing games. It's really interesting feedback. And I think it's like really, really good training for founders. And sometimes you have to push back. Like one of the decks I uploaded, the company was in 7 or 8 trials, and it said like, oh, have any of these trials turned into expansion revenue? And I pushed back. And then I said, if we were at expansion revenues off of enterprise trials, this would be a Series A. I'm raising a pre-seed. And it was funny because the bot actually backed off, and it was like, no, it's right. Getting into 7 trials, like that's good for where you are now. Of course, I recognize this as a pre-seed. I was like, yeah, okay, because that's good practice to know when to push back and what questions you might get, and how to turn that into positive.
I love that. I think that's really smart. So I don't think you missed out on the AI wave. I think you implemented it.
So, yeah, well, the fact that I like literally built this thing
Mhm.
over, you got it up and running in a weekend and then have been tweaking it ever since is really kind of mind blowing. And the funny thing
Isn't that
actually is,
crazy? The whole I mean, I was a developer years ago and I hadn't developed forever. And then I jumped back into vibe code something in like a weekend. And I mean, God, I wish that stuff existed when I was coding back in the day. Like being able to ask somebody questions where I'd have to used to have to go to a reference and like search like a book or two, like probably an O'Reilly book, and there was only like one example in each book. And it wasn't exactly the same thing I was trying to
right,
do or
right,
whatever. Like there was no one to talk to. It was so
right.
lonely. You know?
And it raises the bar for founders too, right? Because like how many verticalized tools now? I mean, I run kayaking boathouse in Brooklyn, and we first of all, I don't know what Airtable is going to do because we're using Airtable as a kludgy backend for our
Mhm.
volunteer CRM database. I
Yeah.
mean, this volunteer sign up thing, this little piece of verticalized software that's kind of feel bad that I'm not using it anymore. It's sort of a little mom and pop operation. And it was kind of a mess, to be honest. And at the beginning of the season, I was just like, I ported everything, grew it at Lovable. I was like, here's how we actually work. Couple weeks, in feedback from founder. I mean, we have check-ins and wait lists and automatically generated follow-up emails and thanks for volunteering. And here's the link to the next shit. It is so next level. It cost me less than $200 worth of credit on Lovable.
Wow.
I think what's fascinating actually, and this is, I just posted on LinkedIn today. I think this is what everybody's kids should be doing this summer is like
Yeah.
going to a bunch of local businesses in their area. Because I think there's an interesting gap. Like Boathouse happens to be lucky that I'm more tech savvy. But if somebody approached us and said, we will do this for you for $3,000, totally yes. Like no question. It was worth that much to us. 5 years ago, that legitimately would have cost you $50,000 and we would not
Yep.
have had the money to do it.
Yep.
There's a window. There's a window to go out and make your summer selling $500 to $3,000 at a pop, little niche solutions for a bunch of businesses. We actually get to learn how that business works. You're just like, hey, what's a pain in the ass for you? Tell me all about that. Cool. Here's an app to fix that. Everybody will be thrilled and you'll have like this amazing work experience that, by the way, could lead to something entrepreneurial, right? You run
Absolutely.
in, you're just like, oh, I didn't know that like plumbers worked like that. I wonder if I could resell the solution to a bunch of plumbers. And then before you know it, you have like, an actual scaling startup.
Yeah, that's great. It's an AI version of a lemonade stand.
Yeah. Yeah, exactly.
That's
Five
great.
cents apps.
Yep, love it. All right, that's a good for anyone listening. That's a good idea. Get your kids out there and doing that. Could be a really good experience for them. All right, if you're a first time founder raising today, what would you do differently from the average startup playbook that we used to use like before 10, 15 years ago?
I think that your advantage is in knowing your customer because anything is buildable, right? And building the right thing fast enough and the conversations with customers is just the real skill. So if you are literally having conversations with people every single day, this is why I actually think that like community driven entrepreneurs have a huge advantage,
Hmm.
right? That I'm constantly referencing people like Brad Hargraves and Sophie Purdom, who, Brad's building Thesis Driven and Sophie did Climate Tech VC, CTVC, and they're building investment products and media databases on top of it because every single day they are talking to customers. They're talking
Hmm.
and you can't like you could build any of the things they've built, but you can't catch up with them fast enough on the new features and things that are driven by the community. And that I think there's a huge advantage. And it's ironic actually that in the AI driven world, you have a huge advantage being a social person who is connected to a lot of humans because then you'll just be faster in building the right thing.
We just have a built-in customer base to just be able to build
That
into, right?
too.
Instead of
Right.
trying to for them or try to find that fit. That's such an advantage.
Right. And go to market is built in, right? Because if everyone can build anything, then the channels are flooded. And
Hmm.
then you're the one they actually like went to the dinner with
Hmm.
and, heard on the podcast or whatever and said, oh,
Yeah.
well, of all the possible solutions, sounds like that person understands what I was going through. So I'll use that person's thing.
Yeah, 100%. And that's a lot of what, like, even with back in the day, Tech Cocktail, Startup of the Year, like established ventures, kind of, we're really focused on community, making sure that we have a connection with the community because of that. Like, it's so important. Yeah, it
For
gets
sure.
us in front of opportunities that we wouldn't have had opportunities before. Okay, so let's move along here from a investor or personal perspective and reflect. You've now written this book. Has anything changed in your thinking and in writing it and in your just being able to dump 300 pages out? Like, anything changed in your mindset from doing so?
Yeah. Plus, I'm no longer investing out of my fund, and partly because I want to have a different relationship with work. As we were saying, in about 5 minutes. I'm going to walk across the street and go pick up my kid. I'm sitting in our local public library's backyard. And I think designing your life has never been so important, and figuring out ways to say, okay, well, if I'm going to go start something or if I'm going to do something, like, how do I align it with, the relationship to work I want to have? And when I was investing full time, what would have happened was after we got off this call, I would have
Mhm.
immediately went into my email and been distracted by what pitches did I see and who do I need to get back to and all of that sort of stuff, which would have taken away from
Mhm.
the time at the park I'm about to go spend with my 4.5-year-old, right?
Mhm.
And so I think about that a lot, and I think about that as a model of entrepreneurship
Mhm.
because I think the tools enable you to scale up to get more out of every person, and I don't necessarily think that means that everybody needs to, in light of that, create a decacorn, right?
Mhm.
You just because your team of 40 can work like a team of 1,000 a couple of years ago, that you all need to be working 996 and
Mhm.
raising all the money and all of this sort of stuff because there's trade-offs.
Yes.
There's friends and family and health trade-offs and all of this sort of stuff. And, doing more with less can sometimes mean you should just do less with less, and you can still maintain the same standard of living in that case. And I think that's totally fine.
I love that. It reminds me of Jason Fried. I don't know if you're familiar with, like, back in the day, 37 Singles, but he's been saying that for 20 years, like, do less
Right,
with less. And yeah, I love that. And you're able to now have control and navigate your schedule and life around it.
right, right.
So that's really cool. It sounds like you're keeping busy though, still with other things. So
Yes, for
book
sure.
and
Like too many projects going on.
yeah, exactly. What conversations, and we're going to wrap here in a second, what conversations do you hope this book sparks between founders and investors, if any?
I think it creates some clarity for founders, feeling like they have a little more control and influence over the process, that they're not just along for the ride, that they are a little bit more in the driver's seat of the conversations with investors, that they feel confident to seek out the right investor for them, do a little more research ahead of time, go in a little bit more knowledgeable, know what they're trying to get out of the process. Because more so than anything else, I just don't want people wasting their time. And I don't want people wasting their time on startups that aren't the best thing they're going to create. And I don't want them wasting time with like investors that aren't that great. You know, prolonged processes that don't create feedback. I mean, one of the things in the book I talk a lot about is how to go into a pitch meeting that pulls information out of it. What did they think? They thought it was interesting. Really? Did they? In what way? What things didn't they believe? Right. And so I just want to save people time more than anything else.
Yeah, I love that. Well, I appreciate you taking the time today. I know you've got a jet here in a second, and I love that you're live from Brooklyn to Park. It's so cool. So thank you for being here. And Charlie, the book is Founder Unfriendly, What Investors Won't Tell You About Getting Funded. Is there anything else? Where can they find you? Is there anything else we should know before we hop?
Yeah, like everything about me, seemingly everything about me, is at thisisgoingtobebig.com, where I've been posting forever and writing essays since 2004. Links to the book is there. And yeah, that's a good place to start.
Great. Charlie, thank you so much for being here. Really appreciate it. And I'm sure a lot of people are going to learn a lot from this conversation and obviously check you out on your own site as well. So thank you.
Thank you.
All right. That's a wrap. We're here with Charlie O'Donnell. And thanks everybody for listening. We'll be back with another episode soon.
Thank you for listening to the Established Podcast. Be sure to subscribe, leave us a review in the App Store, and share the show with friends, colleagues, and on social. Together, we can help more innovators become established. We'll be back with another conversation soon.